Should you get a credit card to help your business? That is a question we're going to talk about today. Should you get your business in debt to a credit card company? So join us as we talk about that. Welcome to the channel, everyone. This is Eat the Elephant, where we teach you to tackle life one bite at a time, because that's the way you eat an elephant, one bite at a time. So this channel is about being in business for yourself, an entrepreneur. We talk about reselling a lot, like on channels like, or platforms like Amazon and eBay, but it's not just Amazon and eBay. So glad you guys are here today. If you're joining me in the live chat, then you can ask a question or leave a comment. I'll do my best to answer it. And if not, you can leave me a question or comment after this video post. So,
are you the manager?
All right. So for those of you who don't know, we've been talking on this channel for quite a while about being in business for yourself and so on. And one of the topics that comes up quite a lot is this topic of credit. And should you get credit or not for your business? And I'm really curious what everybody's thoughts are on this, because I know what my thoughts are, but I know everybody's got a different opinion on this. But I would really like to hear from you guys in the chat. If you're watching right now or afterwards, you can leave me a question or comment and let me know your thoughts. So we're going to talk about credit, because this subject came up in my own personal life just recently. Karin and I were going through our finances the other day, and we realized we had, a few credit cards that had some balances on them. And we realized, we were paying a fairly significant amount of money to these credit cards every single month. And it struck us that, we started to ask the question, why do we have these credit cards? And to be perfectly honest, I couldn't really come up with a good answer to it. So the answer that we came up with was, well, they have in the past been a safety net for if, something else, if something went wrong, you had this safety net of credit. But that's not how we used them. We used them to buy all kinds of things. And I realized, pretty quickly, I said, man, if you look at the thousands and thousands and probably tens of thousands of dollars that I've put on credit over the course of my life, I couldn't tell you hardly any of the things that I purchased with that credit. It was all just nonsense. It was all like, some gas here, some food there, this thing over there, but nothing really of note. And we made a decision in our personal lives to close those accounts. We will pay off all the balances, and we're done. We're done with the credit. We're not going to have it there tempting us. We're not going to have it there hanging over us with a payment. And we just made the decision. We went ahead and closed our accounts. So it got me to thinking about business. And I see some people starting to filter in the chat now. And, I'm curious what you guys have in terms of your credit, or do you have credit for your business? I know that a lot of people who watch this channel are business owners, small business owners, entrepreneurs. Do you have a credit card for your business? Do you use your own personal credit cards for your business? Mark says it seems Dave Ramsey's all about getting rid of credit cards. He is, but there's a lot of other people too. Dave Ramsey's not the first person to say that. So we're going to talk about it. Should you use a credit card in your business? So let's talk about, what does it mean to get a credit card? Because I think there's some confusion about that. And I'm sure a lot of people out there think they maybe know, but really haven't really maybe thought about it on a deeper level. What is a credit card? Well, it's a loan. It's a loan. A bank is saying to you, we're going to give you this open loan for a set amount. Let's say it's $2,000. And anytime you want, you can borrow money from us up to that $2,000 limit. And the rules say that you can basically buy anything that takes a credit card on that and spend that $2,000, right? Sounds pretty good. Now, obviously, just like any other loan, this loan has to be paid back. And the terms of paying it back vary and are based on things such as a credit score, which we'll talk about in a moment. But basically, you pay a rate of interest. The rate of interest is compounded over a year, usually in monthly payments, and can run from very, very low to very, very high, depending on a lot of factors. But basically, you're paying a loan back to this bank that's giving you this credit card on a monthly basis until the amount's paid down. Or if you pay the amount down some, let's say you took out a $2,000 credit card and you spent $2,000 on it, you paid $1,000 of it off, then you could borrow another $1,000 against that open line of credit. However, every month that interest is compounding against you. So it's a loan. I don't want to be misunderstood on that point. A credit card is a loan. It's just like if you went into a bank and said, hey, I want to go buy a mortgage or I want to buy a car, and they gave you a loan. And they said, well, if you put down this amount of money for these terms, we'll give you this loan. The difference with a credit card is, for the most part, you pay a much higher rate of interest. The interest is compounded yearly, but they break it out over each month. And the interest rates on credit cards tend to be much higher than the interest rates for things like for houses and cars. So it's a very expensive way to borrow money, basically. It's a very expensive way to have a loan. Now, the credit card industry is going to tell you that, well, what you need to do is you need to work very hard and pay all your payments on time and don't have too much what they call utilization, which just means if you've got a $2,000 limit, you shouldn't keep it up around $1,800 or $1,900, $2,000 every month. Like, that's too high amount of utilization. You need to be lower, like 10, 15, 20% of your total outstanding balance, or your total outstanding potential balance. And if you do that, we're going to give you what's called a credit score. It almost sounds like a grade you get in school, right? And you get this credit score, and I think they go anywhere from like 350 to 850, 850 being the best. And this credit score is based on things like how timely you are with your payments. Do you get behind or not? It's based on, do you have a good amount of credit, but you're not using a lot of it? It's based on, do you have older lines of credit that you've had for a long, long time? It's based on not having any judgments or liens against you, or foreclosures or bankruptcies or anything like that. And if you do all these things, we're going to give you this really good credit score. And here it is, gang. Guess what the good credit score gets you? It gets you the ability to borrow more money. It's very self-fulfilling, and it's genius on their part. It reminds me of alcohol, which, alcoholic drinks dehydrate you, which makes you want to drink more alcohol. And that's part of their catch for a lot of people. Well, credit scores are like that. When you get a better and better credit score, it shows that, they want to give you, hey, we're going to give you more money if you want, and an even better rate. We'll even reduce the interest for you. We won't charge you an annual fee, maybe. We'll up your limits. You can borrow even more. All these things are what happen with a credit card and credit score. And they all sound very good on the surface. Unfortunately, like most things in life, the devil's in the details, right? The reality is that if you do not pay this balance off every month, that interest starts working against you. And that interest could be very high depending on your credit score and other factors and so on. But your credit score can even go up, even if your balances go up, even if your credit score can get worse and your interest rate can go up. But that interest is what you get charged each month. It could be anywhere from like 0.25% or to all the way up to 2% a month of the total outstanding balance. That means if you had a $2,000 balance, you can end up paying $40 a month just in interest if you had a 24% rate card, basically. And there are cards that are that high, and so it gets very, very expensive, because what happens is when you pay that payment every month, that first $40 goes to that interest. It doesn't reduce the balance. The interest was already accumulating, and then whatever you pay over that 40 starts going towards the principal. So this is all like a long way to say, how do we get to your business? Well, let's talk about your business for a moment. And again, I'm going to give people a chance to chime in here too. And there's some people in the chat saying some things. Your business should be separate from your personal finances. Now, we've talked about that before. Any CPA or financial planner is going to tell you that. You shouldn't mix your business and your personal finances for lots of reasons, tax reasons and so on, tracking. But probably the biggest reason is you need to figure out if your business is making sense or not, and if it's making money and it's meeting your goals, just like your personal life too. But you need to separate those. There's some legal reasons and tax reasons to do that, which means you may get these offers from credit card companies if you've been in business for a while, especially if you're incorporated like I am. I'll get offers sometimes to open up a business credit card and a business line of credit. And they can be very, very tempting because the offer goes something like, hey, open up this business credit card based on your business's history and your sales maybe and so on. And we'll give you a $3,000 limit on it, and you could go buy inventory, right? You could go buy that new DYMO printer like you see over here, my back shoulder, and it'll help your business. And the reality is your business needs money, right? Your business needs capital to grow, to survive, to pay yourself a salary, to pay your employees, to pay your taxes, all these things, to buy inventory. But as we just said with the personal, with the personal example, these credit cards come at a huge cost potentially, because you're getting charged interest each month if you're not paying off the balance. And I know some of you are going to say, and I've heard this caveat from people, well, I'll just get a credit card and not run a balance. And that may be true. Maybe you have done that in the past. Maybe you think you can continue to do that. But I'm going to throw this little question at you. What will you buy right now on credit that you're likely to have the cash to pay for 30 days from now when the bill comes due? And I would argue that most of the year, most of the time, with maybe some small exceptions being around fourth quarter, not much. There's not many things that you would buy on your business credit card right now that you will have the money to pay for 30 days from now. Because what you're talking about there is, guys, is let's say that a credit card company offers your business a $1,000 line of credit on a credit card, and maybe they do it at 15% interest. And they say, here's just $1,000 you can spend. And you say, great, I'm going to go buy $1,000 worth of inventory. And maybe the $1,000 worth of inventory will return $3,000 in revenue, and you'll pay your fees and you'll pay off your cost of inventory. It'll be great. But what are the chances on average that that's going to happen within 30 days? Even on a platform like Amazon, where sell-through is very, very fast, you get in this very tricky game of being able to pull enough money back out each month to pay off the amount that you borrowed. Because here's what happens, guys. If the next month, if you don't have enough to pay off $1,000, let's say you have enough to pay off $500. So you say, well, I'm just running a $500 balance. But now that $500 balance is going to get interest put on top of it. So now that $1,000 didn't just cost you $1,000. It's costing you more than $1,000. And that's where the kind of the insidious nature of credit can come in. It's that when the interest does start accruing, it starts costing you more and more, and the cost of that borrowing becomes very, very high, and much higher sometimes than the rate of percentage that your business is returning. So I think it's a very dangerous game that a lot of us play when we start borrowing. And I've had a couple working capital loans from PayPal, for instance, through my eBay business, which is a little different because it's an amortized loan. All the interest is up front. It's a fee up front. You're done with it. You don't have this revolving interest on the balance. But even there, it was difficult to pay them off. I think I just paid the last one off not too long ago. But this idea of like borrowing money on credit cards for your business can sound incredibly good on the surface, but I'm not sure that it really makes sense when you break it down, because I think you run the risk of not being able to pay it off in 30 days. And therefore now it's cost you money to borrow that money. And you've got to use the business's assets, your cash, which is king, to pay that interest. So now the real true cost of borrowing became even higher. So I'm going to look at a couple of the questions and comments. Drummer says, what about using someone else's credit card? Well, Drummer, if you can get that deal and they don't care if you do it, I would say go for it, right? They would be all, no problem. Using credit cards wisely equals a lot of free money. I'm going to disagree with you there, Melissa. And I think probably you're saying that because of all the perks of credit cards, travel points, hotel points, airline points, and what have you, cash back. But I would argue that for most people, you could just as easily earn those rates of return if you invested that money every month in other types of investment vehicles, not without risk. And credit cards are with risk too, because if you don't pay them off, the risk is that you will go, into that interest debt situation where you're going to be paying an enormous amount. But I think getting a credit card just for those reward points and so on, given the risk of that credit card, don't make a lot of sense, especially for us e-commerce sellers, because here's the problem. And I know some people who run some pretty big credit card balances at different times of the year for their businesses. Suppose you get suspended, guys. Suppose you can no longer sell on eBay or Amazon. You get kicked off the platform. Now, not only have you lost your revenue coming in, now you've got this huge credit card debt looming potentially over the business. It becomes another creditor that you're going to have to pay unless your business goes bankrupt. And even then they would be in line to get paid. So you run that risk. You've put yourself in this position where you're borrowing money to fund your business. And now if your business no longer can bring in revenue, now you're going to have a huge liability there on your ledger sheet and no way to pay it. And let's be honest, you could get suspended on these platforms. It happens to people. So I don't know if that's really the best strategy for most people. Stephanie's never owned a credit card, which is awesome. My debt is zero. Pay cash. Yeah, cash is really a great way to go if you can do it. And I think most people can. It's like the credit card part. It's the same mindset that drives us to get personal credit cards drives us in business. It's like, well, I really want that, but I can't really afford it with what I have in the bank. But this other bank is telling me to loan me the money at a rate of interest, and so then I can get it. Do you really need it? I would say wait 30 days and see if you still want it. And if you do, then maybe you should get it if you really, truly need it. But most of the time, the answer to that is going to be no. Credit history is used for job hires, rental cars, houses, and how much you pay. Bad credit, you pay more. That's true. Some places do use that, a credit score and so on, Mark. But let's think about this. How could you get a bad credit score? The only way that you can get a bad credit score is if you open up lines of credit and then don't pay them, or pay them slow, or have them written off or charged off, or judgments. So really, the very thing that you thought you were helping is what caused the issue. If you never went down that road, you may not have much of a credit history if you don't have credit cards. But there's other ways to get credit history too, by the way, like installment loans on a car develops credit history, and so do mortgages. But credit cards themselves are not really a very good way to build a credit history. They're actually not that effective unless you don't pay them, or you run up big balances, which makes it look like you're not responsible with credit. They kind of only hurt you for the most part and don't help you that much. But a credit score just means you're good at paying banks back their money. So I'm not sure it's really something to aspire to. Let's see. I think Amazon requires a credit card on file. I'm not sure if they allow a debit card. They most certainly do allow a debit card. At least they did mine. Let's see what else. Watch out, credit cards from pirates. Just got to work out capital. We didn't take the full amount offered, just what we needed. Yeah, and here's your issue. Sell quick, ship quick. That's a good name, by the way. I like that. You've gotten this capital loan, and which is maybe not the same quite as a credit card, but now it becomes, can you flip those items back far enough to not pay any extra on a loan? Now, if the loan's amortized on the front end, which I'm not familiar with that, then you're good. Like you've already paid the most you're going to pay for it. But a revolving credit loan, like most credit cards are, for instance, the juice kind of keeps running every month. You're still paying a percentage on that revolving balance. You're not paying just a one-time fee up front. So it can really drain you if your sales drip, or if your sales droop below what you thought they would be. So let's see. I pay my monthly balance in full, groceries, gas, 5% free money. Yeah, and a lot of people do that, Melissa. But the question would always become, if you ran into a situation where you couldn't work 1 month, or your revenue dried up, or even for a few months, God forbid, you lost your job or your business went belly up or what have you. Now you've got one more huge loan hanging over you that is at a high rate of interest, and it's just sitting there compounding and getting worse and worse every month. I don't know that it's an expensive way to borrow money just to get a few perks that a lot of times people don't always use that much anyway. And there's lots of ways to get free perks for things that you buy on credit cards at businesses. They already have their own programs a lot of times that don't cost you anything, and you don't have to get beholden to a credit card. So those might be a better option for a lot of people. Right, Mark. But I mean, Mark is saying, not just as bad. It's also slow credit or no credit will affect your credit history. But here's like, Mark, the premise of what you're saying, and a lot of people think this, the premise of what you're saying is you have to have credit history because you have to buy certain things that require credit history. When the reality is that's not true. There's lots of ways and to go and buy cars, to buy homes, whatever you think you need to have without this extensive credit history. Why do I know that? Because people have done it. So with the right combination of money down or terms or lenders or sellers rather, you're going to be able to find those. So it's kind of a myth that we've been sold by the credit card industry, I think, and the credit reporting bureaus and so on. And certain banks and financial institutions look at credit scores and so on. They just give you a way to differentiate between people in their eyes, but ultimately they don't tell the whole story. And usually it doesn't really help you as much, because, a lot of times you could have gotten just as good a deal without, going through all the shenanigans of trying to pay credit cards off over a decade, just so you can build up a good credit history. So I just think it's one of those things where, it's kind of a myth. And for your business, it's even worse. A business that gets itself consistently in lots of debt, and there are ratios to that. I'm not a financial expert on this, but I know there are, if my CPA, Jared, was on, he could probably tell you better. There's ratios of like debt to your equity and so on that investors look at for a company to decide if the company is being responsible with its cash flow and its revenue and its debt and so on. And lots of companies take on debt and get in over their head very, very quickly. And then it puts them in this really tricky position. I would say for most of us who are probably watching this video, we're small one-man, one-woman shows, or maybe a small company. I think the better course of action probably is try to run your business profitably without debt, because that debt that you incur is going to sop away, that revenue and that cash flow. And most of us are still in small stages, either growing or, trying to grow. And, if you have any kind of money that's being siphoned off to a high interest loan, or even any loan for that matter, that's really going to hurt your growth. And of course it has the risk if if something goes wrong, your model no longer works, or you can't do it on the platform you choose, then you've got one more creditor there that you're not going to be able to pay. But if you always pay off your balance each month, you're losing money by not using a credit for all your purchases. If you can't pay off the balance each month, don't use one. Again, pop-up fishing, we talked about, why not invest that money in something different? And again, a lot of those programs and things that you think you can get money back on, I had a card, it was like a 1, 2, 3 card. It was a 1% off of gas purchases, 2%, maybe it's 3% off of gas, 2% off of groceries, 1% off of everything. But virtually all the places that I went that I used that card, I could have used their free in-house programs that wouldn't have put me in danger of having any debt. So the card was kind of silly to even have, really. And I hear you guys about, getting the 1% back in 2 and 3, but you're running a risk, guys. I mean, if anything happens to your income in a given month, now all of a sudden you've got this whole month's worth of spending on your credit card. That's going to be just one more creditor that you have that's going to be in line with their handout. So I don't know that it really makes that much sense when you really think about it. It's a lot of risk for very little reward. Let's see. Stephanie has paid cash for her cars. Save, yeah, that's definitely one way to do it. Cars are tricky though, because they're depreciating assets. So you typically you want to lease a depreciating asset and buy an appreciating asset, but because cars are not an investment and you just get utility out of them. That's all you get. You lose money on them. They cost money to maintain. They cost taxes to maintain, property tax and so on. So you really want to put as little into cars as you can if you if you're in any kind of financial crunch at all, because they're not an investment in any sense. Hi, Jason. It's Wes. Hey, Wes, what's up, buddy? I know Wes. I run my business debt free. The borrower is slave to the lender. That is true. You're right. I mean, if you owe someone money, they have some control over you, unfortunately. And I don't think that most people should run their business that way. It's not really, uh, it's not really an optimal way to run your business. I'm not going to sit here and say that there's never a place for potential debt to be incurred by a business, but I think most small business owners who get into debt, like the only way that most small business owners can get into debt is with credit cards, because they don't really have the track record and the revenue to get lines of credit, for instance, at a bank or another financial institution. All they can really get are these small credit cards, $3,000, $5,000, $10,000 limits, what have you. And it's, you're running a big risk there if anything goes wrong, with very little reward. So why not figure out how to make your business more profitable rather than going out and borrowing money? Always have an emergency fund if you should lose your job. Yeah, I mean, and you should have an emergency fund if you lose your business too. And that's something, honestly, we need to work on. We don't have the best track record in doing that and having like money saved and put aside for the business for just all kinds of things that come up, like business expenses, taxes, or if like your sales really slipped one month, or you did get suspended or something from one of these platforms. So I think that's a great point. So thanks for bringing up greener pastures. And it's obviously a great point if your personal life, if something goes wrong, rather than going and grabbing, there's Dave Ramsey again, rather than grabbing the $1,000 limit credit card, you grab the $1,000 in cash that you absolutely needed for that emergency. And $1,000, he has a point, and a lot of people have said this, but $1,000 is kind of like a point that if you have it, it can solve a lot of issues that come up. If you don't have it and you need it, it causes a lot of issues. That's about the amount where a lot of people really start to feel the pain of it. $1,000, some people more, some people less, but yeah, I mean, just having some cash like that in the bank like that, just sitting there and not touching it, just ready for the rainy day, which will come, is always smart. Bonnie says, we had 4 stores that sold tile, marble, and granite. We listened to our accountant who talked us into a line of credit. Worst mistake, housing market crash, and we couldn't pay. Yeah, that's a great point, Bonnie. I mean, in that case, you were victims to something that was way out of your control. You couldn't have foreseen that necessarily. You couldn't do anything about it. And it just crushed your business, as it crushed a lot of businesses. And when the housing market crashed, it depended on the housing market and real estate and so on. And the economy in general, for that matter, took a huge hit. And that's a great point, because anytime you're in debt, there were people who were in debt on their mortgages who just had to walk away from, these beautiful, amazing homes because they can no longer pay their mortgages with arms, or they lost their job. I mean, it just cascaded through the entire economy. It's always a good reminder that you need to have funds set aside. And debt, like, you want to have money set aside, but not debt. That's what you take away from this video. Anything else? I have money set aside, but not debt, because debt set aside is no good. So that's something to consider. What if you borrow $5K and you don't get sales? No one can guarantee sales on sites like eBay and you have no savings. Right. That's exactly right. I mean, any reseller who borrows money on a consistent basis, especially credit card debt, is really running a risk. There are people who do it. I know some people who do it on a large scale. But they would be the first to tell you they still are nervous about it, and they have a lot of experience doing it, and they have gotten very, very heavily into credit card debt at various points of the year, and they have a lot of data and metrics to back up that they believe that they will be, their sell-through will guarantee that they will be okay within a few weeks late in fourth quarter. But even in their case, if they got suspended on Amazon, they would be in a world of hurt. It would kind of be game over probably if the suspension went on very long, because all that revenue coming in fourth quarter, they now would not be getting would really wreck their profit models, and now they would also have all this debt on the business, and it would be very difficult to recover for them. Hopefully that won't happen, but it's a possibility, and they know it's a possibility. People make the mistake of not investing profits and have no backup funds. Yeah. I mean, it's a great point. It's like you get this if your business is cash flow positive, and by the way, you kind of need to know that, like over the given course of a month, like what did you bring in and what did you spend on inventory and your operational cost, and what does that number look like? The difference. If you're not positive, then it's hard to think that debt is going to make that any better. I mean, if you're running, like, let's say you're running a $500 deficit every month between what you're bringing in your business and what you're spending on it, that's not necessarily a disaster. You need to figure it out and figure out why, and there could be good reasons for it. But to think I'm just going to go, get this $2,000 credit card loan and that's going to fix it all next month, I think that's really foolish, and not at all the moves of a wise business owner. You really need to examine why your business is running that negative cash flow, and if there is a good reason for it, maybe you continue with that for some period of time if it has to, but ultimately you need to fix that, because it would be much better to have that money just coming in and say, well, I don't need to borrow $2,000 because my business is $2,000 to the good every month. That would be a much better position to be in. But a lot of small business owners never do that. They never stop to think, well, I'm making $50,000 this year. I made $100,000 this year. All right, but what did you net? What was your profit on that? What were your expenses on that? And are there ways to improve that? Are there ways to reduce your cost or improve your profitability? I mean, and there usually are. There almost always are for most people. But borrowing money against, on a revolving line of credit, like a credit card, is a really, really super dangerous way to get yourself in over your head very, very quickly for most of us. And I just don't think that it really makes sense for most of us. But I would definitely like to hear from more of you. So if you guys enjoyed the video and so on, if you have your own thoughts about credit card and debt and so on, or maybe you want to share like a story of, your experiences with it, please do in the questions or comments down below. I'd love to hear from you, and I will do my best to respond. But there's helpful links in the description of this video for our book selling journey, and so you guys get a chance to check that out as well. We're having a lot of fun with that, so we'll be talking about that more and more. One last question here, and then I'm going to sign off here. Do you have a certain amount of cash flow you can use for purchasing the item? Yeah. You know what I do, Drummer? I'm very simple with it. I start with whatever I sold through last month. Let's say I sold 100 items, just to make the math simple, and my cost of goods was $5. Let's just say. I know if I sold 100 items last month and my average cost of goods was $5, I know I have at least $500 to spend on inventory in the next month, because that, as long as I didn't lose money on any of the sales, that money got returned to me in the form of my cost of goods was paid for, if that makes sense. Now, if I'm making profit, I should have more on top of that, but that's what I start with. I start with that number. So just a, good, and you can do that. Anybody can do that with their business. You can do that with your cost of goods, whatever you sold the previous month, your average cost of goods times that many units, you should have that back, unless you've already spent it. But anyway, well, that's going to do it for today, guys. So I hope you enjoyed the show, and leave me some questions and comments down below, and just keep eating that elephant one bite at a time. I'll see you guys soon.